If you're newer to investing, in today's video, I want to explain why dividend investing from blue chip stocks is one of the best forms of passive income that you can consider in your portfolio. If you're new here, my name is Alice. I'm a chartered professional accountant. I used to consult for companies on the NASDAQ and the TSX when I was a director in management consulting. I also worked as a corporate controller for multiple software companies. In the past year, I've built a 6-figure online nutrition coaching business. This is my personal channel where I talk about finance, digital marketing, and some other life improvement stuff. But enough about me, let's move on to how dividend income can help you build wealth. Before we get into it, please hit the like button, subscribe, and turn on the notification bell. So the phrase passive income tends to be used very loosely on the internet, right? Everyone talks about how they have all these sources of passive income. Passive income can really be seen on a continuum. On one hand, we have passive income, and on the other hand, we have active income. Truly passive income is when you press one button, one time, and you get recurring cash from it. Okay, so 100% pure passive income is interest income and dividend income. Now, as we move along the continuum, we have different sources of income. So, for example, something like rental income would be here. Rental income is still passive in nature, but it still requires more setup than just pressing one button. You have to go look for the property, you have to buy the property, you have to get the loan for the property, you have to find a tenant, you have to do repairs and maintenance. So the extra work associated with rental income makes it not 100% purely passive anymore in nature. Also in this category, maybe things like digital products. So for example, if you sell digital products on Etsy, artwork on Etsy, you have to make the design work, you have to do the listing, you have to do the photos. Sometimes you might have to do customer service if people have questions about the product after you've bought it. So digital products, digital courses are somewhat passive, but not 100% pure passive. And then we have things like selling physical products online. So let's say you have an online store and use Instagram as your storefront. Maybe you sell jewelry or clothes through Instagram. Well, it can require quite a bit of setup. You definitely get the leverage of the internet. If you can find some sort of fulfillment company to do the fulfillment for you, or maybe you sell products on Amazon and Amazon does the fulfillment for you, that reduces a lot of legwork for you as a business owner. So that's why selling physical products online is somewhere in between passive and active. And then we have active income, which is like traditional business. Okay, so you have any form of a business, brick and mortar business where you hire employees, you have a plumbing business, a construction business, you have a nail salon, hair salon, whatever it is, right? Traditional business, and also employment. So obviously this requires the most time and effort, and you have to be actively involved in the earning of that source of income. And as we go along the spectrum, these are the different types of income sources and how you can earn them. And truly passive income, where you just press one button and you make money from it, is interest income and dividend income. So let's talk about where dividend income comes from. Dividend income comes from publicly traded companies that declare and pay a dividend. Okay, this is usually from blue chip stocks. And these are companies like 3M, Walgreens, Coca-Cola. So if you, as a shareholder, invest in companies like 3M, Walgreens, and Coca-Cola, these companies will pay a dividend every quarter typically that you will receive in cash that goes back into your investment account or your portfolio. Now, not all well-known stocks pay dividends, okay? So a company like Apple does not pay dividends. The reason Apple doesn't pay dividends is because this is a growth company. It's a growth stock. Companies that declare and pay dividends to their shareholders do that with their after-tax profits. So Walgreens uses their after-tax profits to pay dividends to their investor. Apple, on the other hand, they use their after-tax profits to reinvest back into the company so that the company can grow, right? So that Apple can introduce more products, so they can open more locations. That's why we call Apple a growth stock. Whereas companies like 3M, Walgreens, and Coca-Cola, they don't have as an aggressive growth strategy as Apple does. So they can afford to use their after-tax profits to pay their investors a dividend to incentivize their investors to invest in the company. So that's why a lot of the more cool companies, okay, like Apple, Netflix, they don't pay dividends because they're trying to grow their business. So let's talk about some of the pros and cons of dividend income investing. The first pro is that dividend investing is great for beginners. Dividend investing is a great way to get into stocks if you're more risk averse or you're newer to investing. The reason is that you don't necessarily need a fancy finance background to have a reasonable degree of assurance that your money is working for itself. For example, you know that Target and Verizon are probably going to be around in 5 to 10 years. So in the stock world, these are relatively low risk. The second biggest benefit is dividend reinvestment. Dividend reinvestment is very powerful, and I'm gonna go over an example in a minute to just illustrate how powerful dividend reinvestment is. If you ever heard of the phrase compound interest, this is exactly what dividend reinvestment is. Third pro is that the share price tends to be lower in volatility. So if you check the historical stock price of companies like Target and Verizon, you'll see that the share price over time usually isn't like super dramatic ups and downs. That tends to be the nature of blue chip companies that are mature, stable companies with consistent cash flow. The fourth pro is that the return is basically guaranteed from the dividend income that the company pays. So even if the stock price does go down, technically, because you're guaranteed the cash return from investing in the stock and getting the dividend income, in theory, you can net neutral even if the stock price goes down because you've been getting cash flow from the dividends. So going back to the Apple and Netflix example, one thing I'll say about those stocks is that growth stocks tend to require more sophistication and risk tolerance. Typically, you need to stay in touch with what's going on with the company. The fifth pro, if you're watching this and you're Canadian and you invest in a taxable account, dividends are actually taxed more preferentially than other sources of income. I'm going to explain a little bit at the end of this video, but this does apply for Canadians. Now let's go over the cons. The first one, because dividend income is 100% purely passive in nature, meaning that you only need to press the button one time and you'll get your money working for itself, you do need a decent amount of capital to make this work. There's fundamentally no way that dividend investing cannot work because it's purely just multiplication. And it can work if you have enough capital to invest. Fun fact, but I actually know of someone who makes more off of one dividend payment from one stock every 4 months than most people do in an entire year. That's the power of dividend investing. The second is that this is a long-term investment strategy. Because this is one of the purest forms of passive income, this is almost like a long-term retirement plan. So if you want to have your money work for you, right, work and grow in the background while you go do other things, dividend income and dividend reinvestment is very powerful. Depending on your risk tolerance and how you choose to allocate your assets, it's a great way to build up your portfolio with a set of solid dividend stocks. So if you own some other stocks that are higher risk, it's not a bad idea to have some dividend stocks that will provide you a guaranteed return on the cash that you receive from the dividends. Now, the third con, which is directly related to the lower volatility of the share price here, is that the share prices don't tend to go up dramatically. But that's okay because you're getting the cash from the shares. So let's quickly explain how dividend income works with a very simple example. Say you buy shares in Coca-Cola. Okay, and let's say you invest $10,000 into Coca-Cola stock. The stock price of Coca-Cola right now is about $63. And with $10,000 divided by $63, you get 158 shares. Now, Coca-Cola's next ex-dividend date is on June 14th. So if you invest in Coca-Cola before June 14th, you will be entitled to a dividend payment on July 1st of 48.5 cents per share. So if you own 158 shares of Coca-Cola and Coca-Cola's board of directors announces a 48.5 cents per share dividend, then on July 1st, you will get $76. Typically, we assume that it's gonna be about the same. That's about $300 of passive dividend income that you would get after 1 year. So let's go over another example. You're gonna understand the power of dividend investing when I show you how it works. So let's say that you invest in Verizon stock and you invest $10,000. Share price of Verizon is $41.15, which means that if you divide 10,000 by 41.15, you get 243 shares. But let's show you what this purchase would look like over 1 year. So let's say you start with 243 shares today. Now, Verizon has historically paid a dividend of 66.5 cents per share over the last couple of quarters. So we're just gonna use this assumption going forward. If you had 243 shares at 66.5 cents, that would give you a cash dividend of $162 rounded. So what you can do is you can opt into Verizon's automatic dividend reinvestment plan. And so every time you are paid a quarterly cash payment, you will automatically buy more Verizon shares. Depending on your broker, depending on the company you invest in, you can set this up automatically. Again, it's called dividend reinvestment plan. So if you were to use the $162 to buy more shares and it's trading at $41 a share, you would be able to buy another 3 shares. We do have to round down because you can't buy 3.5 shares of a company, but 243 plus 3, after this reinvestment, you would have 246 shares. Now, because dividend investing is a long-term strategy, we're gonna hold this stock for a while. So if October comes around and you have 246 shares and they're still paying a 66.5 cents dividend, now your cash payment is going to be $164 rounded. And with $164, you can buy another 3 shares of Verizon. And so now you have 249 shares. So same thing, another 3 months goes by and it's January 2025. Now this is where it starts to get powerful because with $166, you can actually buy 4 shares. So you can see what's happening here. Over time, you'll be able to buy more and more shares. And from 249, within 6 months of purchase, you now have 253 shares. Let's go for one more quarter. So this is April of 2025. And now this is 257 shares. So you can see how powerful this is, right? Because over time, you're collecting more and more and more cash. And over 1 year, you've collected $660 in cash. So that's what I mean by this being a guaranteed investment, because if you look at the history of Verizon Communications and how often they've paid dividends, they've been doing this for years and years and years. So you as an investor can be reasonably assured that they will continue to do so in the future. And because you've been reinvesting all of the dividends, your new cost base is approximately 10,576. So when people talk about compound interest, which is a term that you hear online a lot, this is the mechanism that they're talking about. You use your money to make money for you in a relatively lower risk way so that you can spend your time and your effort to do other things. This is what a lot of wealthy people do. A lot of people in the 1%, they make their money through business and then they have their money working for them in the background. But this is what it means when your money is working for itself in the background. I like dividend stocks because you don't necessarily need to check the stocks every single day. You can be reasonably assured that Verizon is going to be around in 5 years or 10 years, right? The last thing I want to talk about quickly is tax and why dividend income is taxed preferentially in Canada. So remember what I said earlier, dividend income is paid from a company's after-tax profits. In Canada, we have a concept called integration, which means that the Canadian government does not want to double tax the corporate level as well as the individual level. So the Canadian government has a dividend gross up and a dividend tax credit mechanism, which basically means that you as a shareholder and individual pay a little bit less tax on dividend income compared to other sources of income.